Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Have you ever looked at two companies with nearly identical compensation plans and wondered why their financials look so wildly different? Well, a lot of the time, the answer comes down to just one thing. Are they using US GAAP or IFRS? Today, we're doing a technical deep dive into the nitty-gritty of share-based payments. We're going to break down exactly how these two frameworks differ and, more importantly, why it's absolutely critical for anyone analyzing financial statements.
So here's our roadmap. We'll kick things off with forfeitures, then get into the weeds on graded vesting expense. After that, we'll tackle the big one, liability versus equity classification. We'll do a quick round on some other key divergences, and finally, we'll pull it all together to see what the real-world reporting impacts look like. Let's get into it.
All right, first up, accounting for forfeitures. This is all about what happens when employees leave before their awards are fully vested. It sounds simple, right? But believe me, this is the very first fork in the road where US GAAP and IFRS go in separate directions.
So, just to be crystal clear, a forfeiture happens when an employee walks away from the company before their stock options or other awards are officially theirs. Now, the big accounting question is this. Do you plan for this possibility from day one, or do you just wait and see what happens? Well, as you're about to see, there's no single answer.
And here is the first major split. US GAAP basically gives you a choice. You can either estimate the number of awards you think will be forfeited and adjust your expense from the start, or you can just recognize the forfeitures as they actually happen. IFRS, though, no choice. It's mandatory. You have to estimate forfeitures upfront and adjust your compensation cost accordingly. So what's the bottom line here? It's a little counterintuitive, but that US GAAP choice to wait for forfeitures to occur can actually mean a higher expense up front. Why? Because you're starting off by expensing the cost for 100% of the grants, assuming no one will leave. So if a company chooses that path, its initial expenses could be higher and its profits lower than an IFRS company in the early years.
Okay, so that's forfeitures. Now let's move on to graded vesting. This is where we see some really significant differences emerge in how companies recognize the cost of awards that vest over time, piece by piece. And look at that, it's a familiar story. Once again, US GAAP offers a choice. You can spread the expense out evenly over the entire period. That's the straight line method. Or you can use an accelerated approach. IFRS, on the other hand, gives you no choice. It forces you to treat each vesting portion as its own separate award, which locks you into an accelerated expense model.
Theory is one thing, but let's put some real numbers to this to see the impact. Imagine a $40,000 award that vests over 4 years. Pretty standard stuff. Let's see how the expense looks in year one under both standards.
If you're a US GAAP company and you pick the straight line option, it's about as simple as it gets. $40,000, 4 years, that's a $10,000 expense in year one. Easy.
But now, look at IFRS. Wow! Because it's mandatory to use that accelerated method, the year one expense shoots up to over $20,000. That is more than double the US GAAP number for the exact same award. It's a massive difference.
And this really hits the nail on the head. That mandatory IFRS approach significantly front-loads the expense. For any analyst out there, this is so important to remember. When you're comparing companies, this rule alone can make one company's early period earnings look way different than another's.
All right, next up, we are wading into probably the most complex area here, liability versus equity classification. How an award is classified has huge consequences for the balance sheet and for P&L volatility, and this is where the two frameworks couldn't be more different. You can think about the high-level approaches like this. IFRS has one clear, guiding test. How is the award settled? If the company might have to pay out cash and can't avoid it, boom, it's a liability. US GAAP, however, is much more complex. You have a detailed set of rules, and even awards that seem like they'll be settled in stock can end up as liabilities if they meet certain conditions.
Puttable shares are the perfect example to make this real. Under US GAAP, you might be able to classify them as equity as long as the employee holds on to them and is exposed to the stock's risk for a reasonable amount of time. But under IFRS, nope, it's an automatic liability because the company can't unconditionally avoid that potential cash payout. It's a hard and fast rule.
So why do we care so much about this? Well, if an award is a liability, you have to remeasure its fair value every single reporting period. And any change in that value goes straight to your income statement. This can cause massive swings in your earnings. It's basically like having to mark-to-market part of your compensation plan every quarter, with all the volatility that comes with it. Okay, let's do a quick lightning round on 3 other technical differences that every professional in this space really needs to have on their radar. They may seem small, but they can definitely move the needle.
First, non-employee awards. US GAAP measures these on the grant date, which gives you a fixed number. IFRS waits until the services are actually delivered, which can create valuation differences if the stock price moves. Second, modifications. When award terms change, both frameworks have rules, but the calculations can lead to different amounts of incremental cost. And finally, payroll taxes. US GAAP waits for a triggering event like an exercise to recognize the expense, while IFRS accrues it over the service period. It's another classic timing difference.
All right, we have been deep in the technical weeds. Let's pull way back now and synthesize all of this. What is the so what? What does this all mean when you're actually looking at a set of financial statements? When you put it all together, 3 key themes really emerge. 1, IFRS generally accelerates expense recognition. 2, IFRS pushes more instruments into the liability category, which can swell the balance sheet. And 3, both standards introduce earnings volatility, but they do it in different ways. With IFRS, it's often from fair value changes, while with US GAAP, it can come from tax impacts at exercise. It's really a trade-off between the flexibility offered by GAAP and the stricter, more prescriptive approach of IFRS. So, what this all means for you is that the next time you're comparing 2 companies, you have to dig into their share-based payment accounting policies. The choice between US GAAP and IFRS can fundamentally change the story the numbers are telling, and it leaves us with this final thought. Which standard actually paints a truer picture of a company's financial health? There's no easy answer, but it's a critical question for all of us to consider.